This is Nightly Business Report with Sue Herrera and Bill Griffith.
Concerns linger. The Dow drops as investors analyze the potential impact of the tariffs and wonder what's next for stocks.
Shot in the arm, an expensive cholesterol drug shows promising results, but will insurers pay?
Toy transformation, why the industry synonymous with fun could soon usher in a new era. Those stories and more tonight on Nightly Business Report for this Monday, March the 12th. Good evening, everybody. I'm Bill Griffith. I'm not in for anybody tonight.
No, you're in for yourself.
I am.
It's so great to have you here, Bill.
I am thrilled to be here and especially to work with my college classmate.
Right back at you.
Yep.
It's a great new chapter for NBR. So we begin the program tonight with Bill and the stock market. The blue chip Dow index fell triple digits, mainly on trade war concerns. Investors are assessing the potential impact of some of the world's biggest companies, namely Boeing, Caterpillar, and United Technologies. One strategist said the stakes are high. A mistake in trade policy could be as big as a mistake in monetary policy. The Dow Jones Industrial Average fell 157 points to 25,178. The Nasdaq was up 27, and the S&P 500 was off 3. Despite today's mixed market, the Nasdaq closed at a record for the second straight session. So what is next for stocks? Bob Pisani takes a look.
The bulls regained control of the markets on Friday, but today, well, not much was swaying stocks one way or the other, and that's a bit of a problem. The market briefly rose on reports that CNBC contributor Larry Kudlow could be the top contender to take over as President Donald Trump's top economic policy advisor, but drifted steadily lower after that. The problem is there's a bit of a news gap this week. With the jobs report out and earnings season winding down, the markets are now entering a choppy period that's characterized by lighter trading volumes and a little bit of intraday volatility, but there's not a lot of conviction one way or the other. Now, we did see defense stocks and industrial stocks like Boeing and Caterpillar lower today. Those were the big winners last week, but not this week. What comes next? Investors will be watching a couple of key inflation points this week, including consumer and producer prices, but not much else until the Federal Reserve's next meeting, and that will be until next week, March 21st. The downside risk is stocks are still prone to these scary inflation headlines, but the good news is we're already retesting the record highs. You know, the S&P 500 is just about 2% away from its old historic high, and the Nasdaq is already there. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Let's turn now to Rich Guarini. He's the CEO of PNC Investments, joining us to talk about where we go in the stock market. It happened again here, Rich, where today stocks that seem to be most exposed to tariffs, that you find them in the Dow and the S&P, went lower, while those not so exposed, those in the Nasdaq and the Russell 2000, went higher. Do you see that continuing?
I think we're at a time, Bill, of high volatility. I mean, when I look at the markets, it's certainly a market that's driven by interest rates, concerns around inflation, and then you add the tariff issue, and I think you have a great combination for continued volatility as we go forward.
So how do you invest against that type of a background for clients? How are you advising them to deploy cash if they have cash? And let's assume that they're longer-term investors.
Well, at PNC Investments, we continue to reinforce the idea of long-term planning. Start with a financial plan, start with a goal-based plan, and really understand what your time horizon is, and make sure, obviously, that in these types of markets, you don't make any rash decisions, and really look and focus on the economy and just overall market fundamentals. And we feel that the market continues to be a great place to be for our long-term investors.
But in the short term, you will have to face higher interest rates. Everybody believes that the Fed this month is going to be raising rates yet again, and maybe as many as 4 times this year. How do you change the investment mix if that happens?
Well, I mean, I think certainly with the concerns around inflation, there's a realistic possibility that the Fed could raise 4 times this year. The market certainly would have forecasted in 3 rate increases, and I think we'll see one as soon as next week at the next Fed meeting. But certainly for your viewers and frankly our investors at PNC, we continue to focus on the long term, and we continue to think that the market is a great place to be as long as you do have a long-term time horizon. But be ready for continued volatility and possible retesting of the lows that we saw the first week of February.
Indeed. Rich, always good to see you. Thank you. Rich Guarini with PNC Investments joining us tonight.
Speaking of those tariffs, China is stepping up its criticism of the tariffs introduced last week by the White House, warning that there will be no winners in a trade war. And as Eunice Yoon reports, steel producers in the world's second largest economy want the government to respond.
I'm at a steel factory of a company that just won within the metals industry here that's calling on their government to retaliate against President Trump's tariffs. The associations that represent China's steel and aluminum industries issued statements strongly opposing the tariffs, and they're now recommending that the Chinese government take action against American imports in their sectors and beyond. For metal products, the manufacturers here say Beijing should target stainless steel, galvanized sheets, seamless pipes, and scrap aluminum. In other industries, they say China should punish agricultural products, consumer electronics, luxury goods, and coal. This is the first time that coal has been mentioned as a possible target. China has ramped up its imports of American coal to 3.2 million tons last year, 5 times more than the previous year, and worth $420 million. Some Chinese analysts are now arguing that Beijing should go after products that would affect President Trump's political base, like coal, and states that gave him the election win. The steel and aluminum industries here don't export a lot directly to the U.S. and are not expected to be affected much at all by these tariffs. And so far, officially, the government hasn't followed through with any of these measures. However, based on this strong reaction, some analysts believe that Beijing could face pressure to take greater countermeasures against any further U.S. action that could impact China's companies. For Nightly Business Report, I'm Eunice Yoon in Langfang, China.
Meanwhile, Canada's Prime Minister has now joined the chorus accusing China of dumping steel on the global markets. And he said today that his country has taken steps to stop it from happening.
We also are very worried about the global oversupply, about China dumping and other places dumping their steel and aluminum, and it's affected our workers here. So we've put in very strong measures, some of the strongest in the world, against dumping. But as I said to the President, as I said to congressional leadership, I'm happy to work with the United States to go even further with them.
Canada, of course, is the biggest supplier of steel and aluminum to the United States, and for now, it is exempt from those steel and aluminum tariffs leveled by the White House last week. Last week, while the NAFTA talks continue, during the interview with CNBC, Mr. Trudeau said that he believes that the exemption has nothing to do with the NAFTA talks and that millions of jobs on both sides of the border depend on the continued smooth flow of trade.
One of the biggest banks on Wall Street may have just signaled who will be its next CEO. Goldman Sachs had 2 heirs apparent for the top job. Well, today, Harvey SCHWARTZ said he plans to retire in April. That clears the way for fellow president and co-chief operating officer David Solomon to become the next chief of one of the world's most powerful financial institutions, whenever CEO Lloyd Blankfein steps down. According to the Wall Street Journal, SCHWARTZ was informed last week that Solomon had the board's backing.
Time to take a look at some of today's upgrades and downgrades. UBS is raising its rating on Time Warner to buy from neutral. The firm believes that its merger with AT&T will go through, but even if that deal does fail, Time Warner shareholders will still win because of the strength of its assets like HBO. And the price target was raised today, reaffirmed at $108 a share. The stock rose 1.5% to $96.75. Meanwhile, Micron saw its price target raised sharply to $100 from $55 at Nomura Instinet, making it the highest price target on Wall Street now for that company. The analyst expects higher memory chip prices to help, and he's forecasting a dividend and share buyback announcement in the coming months as well. The firm maintained its buy rating, and the stock gained more than 8% today to 59.37.
The Dow component Merck was upgraded to outperform from market perform at Leerink Partners. The firm says Merck's key lung cancer drug will perform better than expected. The price target remains $66 a share. Merck was up fractionally to $55.36. Deckers Outdoor, which makes UGG boots, saw its rating downgraded to hold from buy at Pivotal Research. The analyst there says the company will face some tough comparisons following a good winter season. The price target, though, was cut to $108 a share, and the stock fell 7% to $90.28.
Still ahead, the CEO of one drug maker wants to lower the price of an expensive cholesterol drug, but with conditions.
A drug in a new class of cholesterol medicines was shown to lower the risk of heart attacks and death. That's good news, of course, for both patients and the drug maker, but the issue is the price. Meg Terrell has more.
Millions of Americans have high cholesterol, and heart disease is the leading cause of death in the U.S. and worldwide. So when a new class of cholesterol drugs called PCSK9 inhibitors was approved in 2015, the medicines were expected to be huge moneymakers for drug companies. That didn't turn out to be the case. The two drugs, called Praluent from Regeneron and its partner Sanofi, and Repatha from Amgen, have been commercial flops, bringing in about $500 million combined in revenue last year, versus the billions analysts had forecast. Why? One reason is their price, about $14,000 a year before discounts and rebates. Data show that even when doctors are writing prescriptions for these drugs, they're getting rejected more than half the time by health insurers.
Doctors are furious. They write a prescription and most of them are getting rejected. Patients should be able to get the drugs that they want.
The other reason they weren't selling was that while they've proven to lower levels of so-called bad or LDL cholesterol significantly, they hadn't immediately proven that translated into a reduction in heart attack, stroke, and death. This weekend brought those data for Sanofi and Regeneron's drug. In a trial of 18,000 patients who recently had a cardiac event like heart attack, Praluent was shown to reduce the risk of another event by 15%. That's similar to results for Amgen's drug presented last year. But Praluent was also associated with a lower rate of death in the trial compared with placebo, something analysts say may help boost sales. Both results were most pronounced in patients with higher levels of LDL cholesterol to start with. And in that group, Regeneron and Sanofi say they're talking with health insurers about providing steeper discounts on the drug.
One thing is for sure, we're going to lower the price that people are paying for the drug, which is whether it's their insurance company and whether it's patient making a copay. When you add it all up, that's what it costs to get somebody our drug. We want that price to be lower, but we want them to get the drug. That's got to be the bargain.
Competitor Amgen says it's also in negotiations with insurers and has offered, quote, dramatic reductions in price for those who significantly improve access. For Nightly Business Report, I'm Meg Terrell.
Meanwhile, Sarepta Therapeutics plans to seek approval for a second Duchenne muscular dystrophy treatment, and that's where we begin tonight's market focus. The drug maker says that the FDA has agreed to review the company's new experimental treatment for this disorder. Sarepta said that it plans to apply for approval by the end of this year. The company's first Duchenne MD drug was approved back in 2016. Shares climbed 6% today, finished the day at $79.10. Meantime, short seller Citron Research said Netflix could see its stock fall to $300 a share. Citron says that the streaming giant's spending on original content is unsustainable long term, and added that the company faces a slew of competitors who have the money to create compelling content on their own. Netflix shares were off 3% to $321.30. Sue?
Bill, the longtime chief executive of Dow Chemical is stepping down from his role next month. Andrew Liveris, who led the company for 14 years, had said that he would retire once Dow completed its merger with rival DuPont. Liveris, who is now executive chairman of the combined company, also plans to lead the board of directors. Shares of Dow DuPont fell 1% to $71.34. And after the bell, Stitch Fix reported stronger than expected sales in its second report since going public. The online personal styling company said results were helped by more customers, but earnings for the quarter came in below expectations. And with that, shares initially fell in the extended session. They ended the regular day up, however, nearly 7% to $24.12.
Toys R Us may be on the brink of liquidation. As we have been reporting, the big box toy retailer is running out of both time and money, even though it still ranks as one of the biggest toy sellers around. So if it does go under, it would leave a big hole in that entire industry. They could all be gone, and soon. The logo, the giraffe, and the Toys R Us US TV commercials we all grew up with.
I don't want to grow up, I'm a Toys R Us kid.
Here at home, Toys R Us has already closed about 200 stores since filing for bankruptcy last September. And in the UK, it's closing another 200 stores, something once impossible to imagine.
It is simply one of the great post-war retail businesses of America.
Toys R Us can trace its roots to 1948, when Charles Lazarus opened a baby furniture store in Washington, D.C. In 1957, after expanding into toys, he began using the Toys R Us name. Toys R Us went public in 1978, grew to some 350 stores in the 1980s, and expanded internationally to more than 1,600 stores.
The kids sometimes ask me, how did you ever get to be that big? And I said, well, one day I decided to open the second store. And after that, it seemed to get easier.
Yes, it all seemed so easy. Until 1998, when Walmart overtook Toys R Us to become the top U.S. toy retailer. And as quickly as you can say high-speed Wi-Fi, online shopping, with a powerful ability to compete on pricing, began to remake retail. There are a number of folks who track toy sales, but one industry insider says that the top U.S. toy seller today is Amazon, with almost a quarter of the market, up 1% in market share since last summer. Toys R Us is second, but it has lost more than 1% of market share over that same time period. And Walmart is just behind, followed by Target and the dollar stores. Brick and mortar still accounts for roughly half of all U.S. toy sales, but Toys R Us is coming up on a 200-day deadline to renegotiate its real estate leases. And barring any last-minute deals to save the brand, American shoppers may soon learn another American icon is disappearing from the retail landscape.
It will be sad.
If it's true, I'm going to miss it.
I do not want it to close. Do you know why? Because I love toys.
Aww. Stephanie Wissink joins us now to talk more about the changing landscape of the toy industry. She's a consumer research analyst at Jefferies, and I agree with that little boy. I love toys too. So, Stephanie, you make the point in one of your reports that this is going to impact the entire toy industry, not just the Mattels and the Hasbros, but some of the smaller companies as well.
That's right. It's really the end of an era of specialty toys, and many of these small companies that relied on Toys R Us to be their first venue for distribution, relied on Toys R Us to provide them an opportunity to grow their brands and their business. Those are the companies that we worry about the most. Those are going to be the victims of this, ultimately a consolidation event within retail. If they're great, I think they'll find homes, particularly among some of the larger companies, but we do expect there to be some fallout, not only from the retail consolidation, but also from the vendor consolidation.
I mean, the kids don't play with the same kind of toys they used to, right? I mean, it's more digital, not so much physical. Even Lego is suffering right now. Mm-hmm. But why couldn't Toys R Us keep up with those trends? I know they had too much debt. It was tough to service all of that, but why couldn't they just keep up with the trends that the kids were heading into?
It's a great question. I think there are a couple of dynamics. First and foremost, we're talking about what you just mentioned, just constraints on time. Kids today are far more active. They're engaged in organized activities and sports, and so the amount of time devoted to traditional play is starting to decline. We're also seeing electronics become an alternative form of entertainment. I think secondarily, the demographic shift we've seen has really been unprecedented. We have millennial parents now, which are digitally native. They're really driving the retail marketplace, particularly for toys and baby product. And then lastly, you have this financial structure that prohibited Toys R Us from making the investments they probably needed to make to keep pace with those changes in the marketplace. So I think it's been a combination of all of those factors that probably have led to this position where we're now contemplating a world without Toys R Us.
Yeah. What does it do to the big toy companies like a Hasbro, like a Mattel? They've kind of migrated already to Walmart and also to Target and Amazon, certainly. But does it have a material impact on them, or have they seen this pretty much coming?
I think there's been some awareness that there's risk. Certainly when Toys R Us filed bankruptcy last September, it was a bit of a shock to the industry, both just the fact that it happened, but also the timing in which it occurred right in front of the holiday season when a lot of product was leaving Asia on its way to the United States. But I think the secondary fact is the one that you bring up just with respect to these vendors have been building and fortifying the pipelines into these other channels of distribution for many years. So I think it's going to be disruptive, certainly for this year. We would expect that there's some disruption over the course of the next couple of quarters, just depending on the timing of when the liquidations occur.
Okay.
But by 2019, we would expect at least 85 to 90% of Toys R Us's volume probably shifts to these other channels.
Okay.
One big consideration for investors is just the margin implications. Toys R Us was largely a favorable margin retailer. When you look at the scale and strength of Walmart in combination with Amazon, it changes the narrative around profitability pretty quickly. So we think both Hasbro and Mattel, among many of the other large toy companies, are having to reflect on what the margin implications might be as we do see this shift into maybe margin dilutive or less margin accretive categories.
Stephanie, thank you so much. Stephanie Wissink with Jefferies. Coming up, why the entrepreneurial spirit is alive and well at a festival in Austin.
As you may know, South by Southwest started as a music festival, but it has grown into a lot more than that. The event now tech-centered and a place where startups look for investors and media companies go all out to show off their latest programs. And Julia Borston is in the middle of it in Austin, Texas.
The Austin Convention Center is packed with a window into the high-tech future, artificially intelligent robots, and virtual reality experiences. South by Southwest has a reputation for being the place where startups such as Twitter and Foursquare broke out and drawing a range of entrepreneurs along with investors, such as Ashton Kutcher. Kutcher, with music mogul Guy Oseary, his partner in their Sound Ventures fund, hosted a startup competition.
Companies come from everywhere. They come from the Midwest, they come from the South, they come all across the country, all across the world. And you know, we've been coming to South by Southwest for years, but actually doing something that is meaningful for companies, that actually shows and inspires the entrepreneurial spirit all across the country.
Also competing for attention at South by Southwest, media companies creating Instagrammable experiences around their shows and movies, like this Western town HBO built to promote the second season of Westworld.
About 4,000 South by Southwest attendees will get a chance to visit Westworld's town of Sweetwater. But because they're all tweeting and Instagramming their very unique experience here, HBO's marketing message will be heard around the world.
Attendees given hats enter the 2-acre town of Sweetwater to talk with 60 actors who never break character. HBO says the investment is worth it.
A lot of our hosts here are armed with guns, but our guests are armed with cameras. So they're out here Instagramming, live streaming, and really helping us extend the reach.
Warner Brothers, promoting Steven Spielberg's upcoming Ready Player One film, invited fans into a space that recreated the world of the movie. And ABC, aiming to drive viewers to watch Roseanne's return, replicated the show's iconic living room, encouraging visitors to take and share photos, hoping to turn the influencers here in Austin into evangelists for their content. For Nightly Business Report, I'm Julia Borston in Austin, Texas.
Here's another look at the day on Wall Street. The Dow Jones Industrial Average fell 157 points to 25,178. The Nasdaq was up 27. That's a record. S&P 500 was off 3. That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We will both see you tomorrow. Good night.
I'm Sue Herrera with a nightly business report news brief. On Wall Street, the Dow fell triple digits on lingering concerns about a possible trade war. The Dow dropped 157 points to 25,178, but the Nasdaq was up 27, closing at a record, and the S&P 500 was off 3. Goldman Sachs co-president Harvey SCHWARTZ plans to retire next month, leaving fellow exec David Solomon in line to take over whenever CEO Lloyd Blankfein steps down. The longtime CEO of Dow Chemical is stepping down next month. Andrew Liveris, who is now executive chairman of the combined Dow-DuPont, will also leave the board of directors. And Berkshire Hathaway's CEO Warren Buffett will give $1 million a year for life to any of his employees if they fill out a perfect March Madness bracket. The odds? 1 in 128 billion. Be sure to tune in to Nightly Business Report here on your public television station.